Okay, let's now look at fiscal policy and fiscal policy using aggregate demand. Okay, there are three ways fiscal policy can be used in terms of aggregate demand. First, of course, we know that aggregate demand is equal to C plus I plus G plus X minus M. Right? So in the first instance, it's a simple case of changing government spending. Right? All you then need to do in this situation is increase government spending to increase aggregate demand, or reduce government spending to reduce aggregate demand. This will shift your aggregate demand curves. Okay. The next thing we can say, which is really number 2 and 3, right, is to change disposable income. Disposable income, YD, disposable income. This will involve making changes to either or both tax and transfer payments. Okay, tax or transfer payments. So let's explain that in a bit more detail. Okay, so actually, what makes disposable income? Disposable income is made up of your actual income minus the tax you have to pay plus any possible transfers you get from the government. Okay, so an example of a transfer from the government is unemployment benefits. A transfer is when the government gives you money and you don't have to give them anything in return. Right? You just accept the money. That's a transfer. Alright, I mean, for example, so we have that, and then I'll just give you an example. Different colored pen. If your income is 100 and tax is $10 and transfers are $20, your disposable income is $110. Alright, so that's just the example. So disposable income has an impact on aggregate demand. So let's just draw out aggregate demand again and explain that. Okay, aggregate demand is equal to C plus I plus G plus X minus M. Now, what happens is we take aggregate demand, we take disposable income, and when we change disposable income, that will change consumption and investment. Alright. If you increase disposable income, you have more money to spend. You have more money to spend, consumption will increase. As people start to buy more, businesses will start to invest more. So an increase in disposable income would lead to an increase in consumption and or investment. Whereas a fall in disposable income, right, in this situation, a fall in disposable income could be because we are moving from this situation to one where tax has increased to $30 and transfers are cancelled. $70 now. Fall in disposable income. What happens now? Consumers spend less, businesses will invest less because people are buying less, aggregate demand will shift downwards. Okay, so there are three ways in which fiscal policy using aggregate demand can make a difference. One is to change government spending. If you increase government spending, you shift aggregate demand outwards. If you decrease government spending, you shift aggregate demand inwards, or you can play around with disposable income. That will also lead to a change in aggregate demand via a change in consumption or investment.